It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. The Federal Reserve has done it again. Recently, they raised interest rates another quarter point. So now the federal funds rate is 5.25%. Now, that may not sound like a really high number, but when you consider just over a year ago, the Federal Reserve was only 0.25%. And that is an increase in just over a year of over 20 times, 20-fold, from 0.25% to 5.25%. Now, why is this so important? I was sharing this with a client actually just a few days ago. And I said, if you want to understand interest rates and the markets and how it affects the economy and all those types of things, there's two rates that are of primary importance. And the first one is the federal funds rate. And that one's important because that's the rate the Federal Reserve sets. And that's the one you hear about in the news when they raise or lower rates. And either directly or indirectly, pretty much all other interest rates are influenced or affected by the federal funds rate. Now, first of all, what is a federal funds rate? Well, that's the rate that banks charge each other to borrow overnight, or the overnight discount rate, or the Fed funds rate. Different terms you hear for the same thing. You see, banks have to balance their books each day. They have to have so much X amount of reserves based on loans, that type of thing. And a lot of people are rarely very aware of it. I learned much about this with my time acting as a chairman of the board of a bank, and we were in the process of starting a bank in an FDIC insured bank. So I got a chance to get firsthand learn a lot about this. And of course, a lot of my clients and people I talk to know I have had some banking experience, and with the recent bank failures, there's been, they've reached out to me with a lot of questions because they know I have some experience in that area. So I'm going to share some of that today. So I'm going to really encourage you not to miss this show, because even today, the most recent federal funds meeting, it was interesting when the Chairman Powell, after the Federal Reserve announced they're raising rates a quarter point, literally the first, I don't know, half a dozen questions or more that were asked of him were about the recent bank failures and is our banking system safe and what to expect and all that going forward. These are very, very important things to be aware of. I'm going to discuss these things directly today and give it to you straight. Now, first of all, the Federal Reserve, like I said, and Chairman Powell came out recently and just said that the banking system is secure and all that. And the thing is, they pretty much have to say that. I mean, think about it a minute. If the Federal Reserve came out and said, hey, well, there's a problem in the banking system, there would be a run on banks like we've never seen, and it'd be over. So they have to support the banking system, because if you understand fractional reserve lending, which is the fancy term for banks, when you deposit money in the bank, and all the money isn't there. In fact, the majority of it is then loaned out, and different types of loans, car loans, home loans, and et cetera, to earn interest. That's how the banks make their money. And that's why, for example, the average bank in America has approximately 8% of the deposits on hand. In fact, a bank traditionally through FDIC, when they get below 6% in cash reserves, that's when they go onto the FDIC watch list. And if they get below that, then the FDIC often steps in and takes over, okay? And they close the bank and have another bank take over. These are things that are important to understand these days. Is your money safe in the bank? Well, first of all, I want to say, if you've got less than $250,000 in a bank and it's FDIC insured, you're in good shape. The FDIC will make all the depositors whole, even if your bank failed, okay? So for most people, there's not any real risk of losing their money deposited in a bank, okay? Now, the key problem is for those with larger than $250,000. And, it's wealthy individuals and businesses, of course. Businesses probably have the biggest challenge here because the reality is if you have a significant business that goes through over $250,000 of expenses, let's say you have over that in payroll, for example, and they have to make payroll. How do they have to have the money set aside in a bank account to make that payroll, for example. And if they're over those limits, of course, then that money is not safe or insured. For a business of that size to be dealing with a smaller regional bank these days with this economy probably is not a good financial decision. And of course, many of these wealthier individuals and businesses are moving their monies out of the smaller regional banks and putting them into the big banks like the JP Morgans and Wells Fargos of the world. And that's probably a smart move for them because although their money is not insured over the $250,000 limit, there's the pretty well understood too big to fail banks. And that's probably the top 3 or 4 banks in the country. And if you're a large business or have large holdings in banks, you probably should be dealing with one of those larger banks. It's just the reality of the matter. And those larger banks are geared for those types of business, larger size sums. You know what I mean? The fact that people are moving their money out of the smaller regional banks is sad in a way, because again, if it's FDIC insured, they're good to go for up to $250,000. And it's the smaller regional banks that are really the lifeblood of our economy and the freedoms that we offer. Because I'm going to talk more about ESG and those types of things in this today's show. But many of those smaller regional banks, they're your neighbors. You know what I mean? They're local business people who may probably more likely agree with you than disagree, if you know what I'm saying. And they're not caught up in the politics of Washington oftentimes. Some are, we've had a couple of them fail. What is it? Silicon Valley Bank, for example, was a very political bank. They were proudly called themselves the most woke bank in America. And of course, they were the first to fail, interestingly. But anyway, that's a whole different discussion. My point is your money safe in the bank? If it's FDIC insured and you have less than $250,000, you really don't have anything to worry about. And if you support, and you should, we need to support, especially in these times, need to support our local banks. And again, your money is not at risk. So I would really encourage people to continue to do that. It's the bigger accounts or the bigger businesses that need to move their monies out and go to the bigger banks so they can make sure that their money is safe. Should there be concerns about other bank failures and things like that? And the answer is, well, absolutely. The problem is being caused by the Federal Reserve and the rapid increase in interest rates that they have put on over in the last year, a little over a year. Like I was starting to say, the federal funds rate has gone from 0.25% just over a year ago to 5.25%. And that's the rate that banks charge each other to borrow money overnight so they can balance their books. Now, that's a 20-fold increase, a 20-time increase. That is the most aggressive increase in the history of the Federal Reserve, over 100 years. It's very significant. It's not the highest rate the Fed rate's ever been. That was in the 1970s. It hit 20% at one point. But it's the fastest rate of increase, certainly, in the history of the Federal Reserve. And that's what's so significant about this. Again, the economy has been running for the past decade or so on easy monetary policy, low interest rate environment, easy money, cheap money, and that, of course, fuels growth through businesses, real estate, and various things, increase in value of assets, things like that, because of the cheap money. Of course, that is now gone. That has changed dramatically. Now, the other rate that's so important, I started to discuss before, and I kind of got off on a tangent a bit, is the prime rate. Now, individuals, this is a rate that individuals should really pay attention to. Because, again, you and I are not going to borrow money at the federal funds rate. We're not a bank, okay? We're individuals or small businesses, that typically, right? So the prime rate is set by the Wall Street Journal, and it takes the average of the top 30 banks in America, and it takes the average loan rate for that these banks charge for their customers with good credit. And on average, the prime rate is about 3 points, 3% higher than the Fed rate is, because 3% roughly is the spread, if you will, that banks the profit. And there's a bank could borrow money from the Fed at 5.25, right? And then they charge they charge loans at 8.25, which is the current prime rate. They make 3%. That's their spread. That's the bank's profit. That's what they operate on. Again, with their clients with good credit. Like I said, all interest rates are either directly or indirectly affected by these rates. The Fed rate, the prime rate, like I said, is approximately 3% higher. Fed plus 3. 30-year fixed mortgages, for example, follow the prime rate fairly closely. Again, it's 8.25. 30-year fixed mortgages for somebody with good credit is around 7% right now. Probably is climbing. It's probably going to start climbing towards that 8% range soon. A year or so ago, again, when the prime rate was 3.25, you could get a 3% 30-year fixed mortgage with good credit. Okay, so again, it's all in perspective. Now, I'm going to encourage you to stay tuned in the next segment, because one of the things your personal bank does is it allows you to borrow money today, right now as we speak, this year, at 5.7%. When you consider the prime rate is 8%, 8.25 actually right now, and you can borrow at 5.7, that's significant, okay? That's a significant savings. And what I'm going to share with you in the next segment, so again, I'm going to encourage you to stay tuned, is I was discussing this with a client literally today, where they're getting ready to purchase a car. They were going to finance it, but instead of paying the 7, 8, 9% interest rate that they would be charged today for that auto loan, they were able to access funds from their personal bank policy. And because they're earning 5.75 dividends right now, and they're getting charged 5.7% interest currently, their cost of their loan is basically nothing. What I'm trying to say is they saved all that interest. I'm going to share with you how to do that in the next segment, so I'm going to really encourage you to stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. And one of the things I was sharing in the last segment, and I'm really going to encourage you, if you missed it, go to yourpersonalbank.com, because you can listen to this or any of the previously recorded shows anytime you want. Again, it's yourpersonalbank.com, is we can, depending on which company we're working with and the size of your account and such, we have borrowing rates that are in the 5% range. And that is significant. That's today, especially given that the prime rate right now is 8.25. A 30-year fixed mortgage with good credit is in the 7% range for most people. An auto loan is probably 7, 8, 9% with good credit right now. Let me use a quick example. So I was discussing this with a client today. They had funded some money in their personal bank policy. In their case, they're earning 5.75 dividend, insured, guaranteed, tax-free right now. And that's locked in through 2023, through the rest of this year in their example. Now, if they leave it there, of course, the money's just going to grow, right? That's pretty straightforward. But they want to access some of the funds to purchase a car. Now, they have a choice. They, of course, could go finance that car, pay 7, 8, 9% interest on that auto loan, because that's what it's going to cost you today. Or they could take some cash, pay for the car, or they can use the personal bank policy to pay for the car and eliminate the interest cost. Now, how does that work? Most people understand financing. Obviously, if you borrow money, you're going to finance to purchase that vehicle, you're going to pay more than the cost of the vehicle. You're going to pay whatever the purchase price is plus whatever interest payments are, right? That's pretty straightforward. Most people understand that. The second option, like I said, is you could, if you have the funds available, you could take cash and just pay for the car. Obviously, the advantage to that is you don't have the finance cost, the extra borrowing costs of that vehicle. And with higher interest rates like they are currently, that is more appealing, obviously, than when interest rates were lower a year or so ago. Now, the disadvantage of taking cash or just paying cash for that vehicle or any item for that matter, typically you're going to take that money from an investment or some other source where it could have earned money. I mean, my gosh, today you can put money in a money market account and earn 4% on it today. But instead of doing that, or you're taking that money and you're buying that car. Well, what happens to those dollars that you used to purchase the vehicle? Well, of course, obviously, you traded those dollars for the vehicle, right? And what that means is you gave up the ability of those dollars to earn interest for you this year and every year the rest of your life. They're gone. It's like once you spend those dollars to purchase the vehicle, the money's gone forever, right? You're never going to earn any interest on it. And that's one of those financial literacy keys. I was discussing some of these things in last week's show, actually, that I've taught in college accredited course, all this kind of stuff over the years. This is one of those financial literacy keys that most average Americans miss. They don't understand the difference of what the typical person does versus somebody wealthier. The wealthy tend to do, okay, with money, because they're not educated. Most people just lack a lot of financial literacy, and it's just a sad fact. I wasn't taught this stuff growing up, and neither most of us weren't, right? We weren't taught this in school. Most of us were not taught any of this by our family or anything else, because our family didn't have good financial literacy either. They might have done okay, don't get me wrong, but there's good, better, best. You know what I mean? So the best way to go about it is using the personal bank concept to purchase the vehicle. And here's why. Because if you have the money to pay cash, why not instead invest the money in a personal bank policy to earn dividends? You can do it over time or all at once. It's up to you. It depends on your situation. And then access the funds, borrow against it using the cash as collateral. All right. And you take that money and you purchase that car. That's what this client is doing. Now, why is that better? Why is it superior to just say paying cash and buying the car? Well, the answer is really quite simple. If you put it in the policy, it's going to earn dividends. The money's going to grow. Now, when you access the funds, and this is where people get caught, this is where if they miss it, this is where they miss it. I'm telling you right now. So I'm going to encourage you really to listen close for the next 30 seconds or so, because this is the key. This is really important. When you put the money in the policy to earn dividends, it's growing. When you access the funds, do you access it through the bank line or through the insurance company? And the answer is typically through the bank line. In other words, the money, you're not taking it out of the policy. It's still continuing to earn interest and dividends. You're borrowing against it. Now, you have a cost of borrowing. I told you in the example of the client today, is their borrowing cost was 5.7 today. We have borrowing rates are in the 5% range, just so you know, today. Now, typically, well, let me finish this thought, and then I'll go with what's typical. This is the worst case scenario. They're making 5.75. They're getting charged 5.7. That means they're not really there's really no positive arbitrage, and that's because of what's going on with interest rates. I'll talk about that further in a minute. I want to finish this thought first. This is this key thought. By taking the money and accessing it, borrowing against it, using the cash and the policy as a collateral, and paying for the vehicle, now what happens? Well, they bought the car, right? But that money, did they give up control of the money? That's the key. And the answer is no. The money, those dollars, are still in their control and their policy, earning dividends this and every year the rest of their life. Why is that so important? Why is having control of that money so important? The reason is simple. It's because if you maintain control of those dollars, instead of just trading them for the asset, giving up control of them, you can still earn future dividends. Now, yes, when you're borrowing against it, you get an interest cost. Right now, in their case, the dividend and the interest costs were basically the same. So in other words, they weren't benefiting, they weren't getting helped, they weren't being hurt this year, but they still have control of the dollars. Why is that so important? Well, over the last 42 years, we've had a positive arbitrage situation. This is a very, very rare year because the Federal Reserve raising interest rates so quickly. Most of the time, what you earn, the dividends you earn, is more than the interest rate you get charged. And therefore, you get to keep the difference. That's known as positive cash flow or positive arbitrage. So even in this example with this client buying the vehicle, even though this year they may not receive any benefit from doing it that way, next year they probably will, because all that needs to happen is dividends go up, which we fully expect that to happen due to higher interest rates, or borrowing rates go down, which at some point they will, and you get to keep the difference. When the dividends are, what you're earning is more than what you're getting charged, you get to keep the difference. And what if that difference is just 1%? Well, add that up, 1% a year for the next 10 years, 20 years, 30 years. How long are you going to live? And do you understand compound interest? If you do, you start to realize that can add up to quite a bit of money. By the way, the average positive arbitrage scenario is more like 2 to 3% per year. Again, 2 to 3% may not sound like a lot, but compound that over a decade or 2 or 3 or more even. And you quickly realize that the amount of interest through compounding, through the positive cash flow, through the positive arbitrage, can end up being as much interest, the interest you get to keep, can end up being as much as the total amount you spent for the vehicle. What if you got that back in the next decade or two? What could you do with that money? You literally could buy another vehicle from the interest you earned on the money you spent on the first vehicle. Does that make sense? Do you follow me? If you don't, I'm going to encourage you to contact me at yourpersonalbank.com. Be happy to explain it to you further or answer any questions you have. The point is, if you're going to go buy the car anyway, would you rather give up those dollars and trade those dollars for that vehicle? Or would you rather put them in a personal bank policy, earn dividends on it, and then borrow against it, purchase that same vehicle, and still earn in some interest on that money each and every year the rest of your life, which means by definition having more money? Folks, here's the thing I want you to understand. When people understand that concept, when they grasp the idea that you can maintain control of dollars even if you use those dollars to, say, buy a car or invest in something or pay bills or do whatever it is you do with the money, supplement retirement, I don't pay for college, doesn't matter. When you get the understanding, you get the idea and realize, holy cow, I can keep some in the interest. I can still earn some interest on those dollars that I spend on things. It will change your financial future. It changes dramatically the trajectory of your financial situation for the rest of your life. And not only for the rest of your life, by the way, oftentimes for the rest of your kids' children's life. It changes generational wealth, folks. This is how the wealthy often operate, and the average middle class, upper middle class, etc., do not. This is the difference, again, of the wealthy mindset and the people with some financial literacy that understand control of dollars, keeping the ability to continue earning interest on those dollars even after you spend them for other purposes, like purchasing a car, for example, or anything else for that matter, is the key. That is the key, folks, to changing your financial trajectory. It's the key to building wealth. It's not just about making more money, and it's not just about accumulating more on paper. It's about actually keeping control of your money even after you spend it. That is the difference. And many times I see, from a financial standpoint, with many people I work with, the biggest difference in their financial lives. Stay tuned in the next segment. I'm going to dive into some more of this and some more of the bank information and things you should be concerned about. And I'm going to share with you how to know if your bank is likely to be one of the next banks that might have trouble or fail even potentially. So stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. And one of the big questions I've been getting asked a lot is the money in the bank, my bank, safe? And I'm getting asked that a lot because of, I'm in the financial industry. I also was a chairman of the board of a bank for a while, for several years. So I've got some banking experience, and I understand how banks operate far more than most people. I mean, I was on the board of one, right? So there's no question that we're dealing with a banking crisis, okay? In fact, the three banks that have already failed this year in 2023, Silicon Valley Bank, Signature Bank, and now First Republic Bank, in the total amount of assets that those three banks held already exceeds the total amount of all the banks that failed in the 2008 financial crisis. In other words, from a bank failure standpoint, we are already in a worse position than we were in 2008. Now, by the way, in 2008, just so you know, there was 25 banks that failed through that period of time, through the 2008 through 2010 roughly period. The largest bank failure in history also did happen during that time period, Washington Mutual. That was the largest bank failure in the history of the United States. Okay. The other 24 banks that failed were all smaller banks. So the total assets that, of those 25 banks was slightly less than the total assets of the three banks that have failed in 2023. And folks, if you think that bank failures are behind us and that we're done, I'm going to tell you, you're pretty naive. You have to be very naive to think that the struggles with the banks are over. And the reason behind the struggles of the banks, if you don't already know, is really quite simple. You see, banks have to, they invest too, right? When you put your deposits in there, of course, they loan money out for, car loans, home loans, various types of loans, right? Business loans, whatever. They also invest in assets, okay? And one of the assets that banks often invest in quite a bit happen to be bonds, okay? And bonds are highly interest rate sensitive. And unfortunately, the bonds that banks were purchasing for the past decade roughly were paying very low interest rates because we were in a very, very low interest rate environment, thanks to our Federal Reserve. And I stated in the first segment, in the past year, the Federal Reserve has increased interest rates at a more aggressive rate, faster, more rapid rate than at any time in their 100-year history, 100-plus years. So now the bonds that banks are purchasing, or anybody else for that matter, pay a higher interest rate. Okay? They're highly interest rate sensitive. The amount of interest the bond pays is affected by the current interest rate. Therefore, the bonds that the banks bought over the past decade are worth less because they pay lower interest rate, right? Pretty simple. So the value of those bonds are decreased. So the value of the bank's assets, the investments, are less or reduced, which causes a banking crisis. Folks, this crisis, sadly, has been caused directly by the Federal Reserve. And indirectly, why is the Federal Reserve why is the Federal Reserve raising interest rates the way they are? Well, because inflation has gone too high. And they're trying to get it back down to their target rate of around 2%. The last numbers have been around 5.5%, so it's still far higher than the Federal Reserve wants to see it. And why is inflation so high? Well, the government spent too much money. It's just really plain and simple, and they've interfered with energy production, which also affects inflation. The government has created this problem. The government is now creating, by trying to fix one problem, they've now caused another problem. The government is really, really good at causing problems. And whenever they try to fix one, they typically will cause another. They cause the inflation problem by spending too much money and interfering with energy production. The Federal Reserve now is trying to fix that problem, the inflation problem, by raising interest rates, which is now directly creating another problem, and that is, and they're doing it rapidly because they did it, so they did it so slowly, or they were late to the ball game. Inflation was going up far before the Federal Reserve started raising rates. So they were late to the ball game, slow to react, and of course now they're trying to play catch up, which is so they're doing everything rapidly and aggressively and raising the rates, which is now causing a banking crisis. I'm going to predict that there will be more bank failures going forward. And I believe it'd be highly naive to think otherwise. And some of the banks that, depending on when you listen to the show, this is a fast moving situation. But recently, some of the other banks that have been having challenges are PacWest, Western Alliance, okay, Zion, Comerica, KeyBank. Those are some of the other ones that have recently been having struggles because investors and people have come to realize that their reserves, all that kind of stuff, are not looking good. How do you know if your bank is strong or not? Well, first of all, is your money safe? Let's answer that question first. Well, if it's an FDIC-insured bank and you have less than $250,000 in it, you're good to go. FDIC will take care of the depositors, and you should have little concern about losing money in a bank if you have less than $250,000 in there. There is discussions, gray areas in terms of you had multiple accounts, or like business or personal accounts at the same bank, whether you would be protected by FDIC. It's kind of a gray area, to be straight up with you. The smartest thing to do if you're really concerned about it is just have different banks. If you have, if you're approaching that $250,000 limit, just spread it around. I have a number of clients, folks I've talked to, who do have significant assets in banks and businesses and such, and that's what they've done. They're doing that or have done that. They're spreading it out into multiple banks to keep less than $250,000 total in any one bank, and that's just smart. That way, FDIC will have you covered. Okay, if one of them goes down. The bigger bigger businesses and stuff who deal with a lot more money than that, they frankly should just probably be working with one of the big banks, which are less likely to go down because they're too big to fail, quote unquote. The government will probably step in and bail them out like they've done before. But if you want to know if your bank is safe, the best place you can go, really, is the Uniform Bank Performance Report. It's the UBPR. And the place to go to find that, I'll give it to you right now. It's ffiec.gov/Uniform Bank Performance Report. Again, that's ffiec.gov, Uniform Bank Performance Report. That is the website. It's free. This is the bank report that regulators use to determine the strength of banks. Its report is done quarterly, and it will give you all the information you need to know, the same information bank regulators are using and FDIC is using to monitor the financial health of banks. And this website, like I said, you can go to it. There's instructions that'll tell you where to go, the link to go to the actual performance report, and then how to pull up that report. It's pretty easy to do. It's free. The report's very involved and detailed. I'll tell you that straight up. You probably, unless you're familiar with spreadsheets and financial reports, you might want to have somebody look at it to give you an interpretation. If you want to pull up or want to look at information on one of the banks, I, of course, have experience with that, having formerly been on a bank board. I can help you decipher whether the bank you're looking at or working with is safe or not, or strong. Let's put it that way. You can send that to yourpersonalbank.com. I'll be happy to help anybody out with that. But again, the place to go to get the report it's a free report. It's a government bank regular report. Last time, I want to share it. ffiec.gov/Uniform Bank Performance Report. You can also go to yourpersonalbank.com. My website will post it there, so you can go to that link and check it out. That's probably the best. Like I said, that is the best place to go to determine whether your bank is financially strong or not. But like I said, if you have less than $250,000, you have little concern. FDIC insured, you're going to be fine. Okay. Just understand, I guess, the bigger thing. And like I said, the bigger picture is, as I was sharing in a previous segment, supporting everybody moving their money to the large, too big to fail banks would be very, very detrimental to our economy and to our freedoms, because we all know, if you haven't been paying attention, ESG has kind of taken over a lot of the big corporations, including the big banks. Okay. The environmental, social, and governance initiatives, which are very controversial at best, and detrimental to most people's freedoms, and what were, instead of being fiduciary responsibilities of investments, they're focusing on other things that are more political. And frankly, the financial institutions, businesses, banks should not be dealing with that. And your big banks, of course, are. Your local and regional banks, for the most part, are not. They're more probably in tune to your beliefs. They're your neighbors. Business people, they probably have a lot more in common with you than a big bank does. And big banks are really geared towards dealing with big, large customers and businesses and stuff. Most individuals have no business banking with a large bank because they're just a number. You're not going to get any service. In fact, you deal with a smaller regional bank, you'll be shocked many times at the level of service you'll receive. It'll be like the old days where they actually know your name. It's amazing. I walk into my local bank and they say, "Hi, Ference, Mr. Toth, how you doing?" It's awesome. You know what I mean? It's nice. And you get service. And again, if it's FDIC insured, you're good to go. So I'm going to strongly encourage people to stay with, or if you haven't, move to a local regional bank and support them. Make sure it's one that you agree with and have the same beliefs, that kind of thing. But we really need to continue to encourage that, because if we don't and everybody ends up moving to the large banks, we're going to have 3, 4, 5 bank options eventually, and that's it. Just like today, how many options do you have to say on a smartphone? There's a handful of options, but that's it. I'm going to encourage you to stay tuned in the last segment. I'm going to share a few other things I think you're going to find very important, including Biden's latest fee that he's added to mortgages. Stay tuned. You don't want to miss this.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. So the thing is, we have a situation here where a lot of people are asking the question, is the money in my bank safe? That type of thing. And like I was sharing in the last segment, I just really, really encourage you to check out, go back to yourpersonalbank.com. You can listen to this or any of the previously recorded shows. I shared with you what you should be concerned with, the website you should go to. We'll have the link to that to get the Uniform Bank Report. Uniform Bank Performance Report, if you want to do that, so that you can determine whether, whether your bank is, financially solid or one of them that might be in trouble. Are we going to have more banking failures going forward? Highly likely. I mean, that's just the reality of the situation. So, check it out. I really encourage you to do so. If you have any questions, contact me, yourpersonalbank.com. This latest thing that's come out, you're going to love this. Not really. It's ridiculous. So it's a mortgage redistribution plan. If you haven't heard about this, it's ridiculous. Basically, and this has actually already gone into effect. And this is another one of those situations where we have a out of control government with too much power, too many unelected bureaucrats imposing things that they just have no business they should not be doing. I mean, it's just really that simple. Okay. And what it is they're they're adding fees for people with better credit. So if you have a 680 credit score or higher, they're going to, on the mortgage, this is happening now, cash out refis, whatever, you name it, you're going to have to pay a fee. On average, on a $400,000 mortgage, for example, the average fee is going to be extra $40 a month, which will be added on to your monthly payment. Over 30 years, $40 a month, that can add up to a lot of money. I mean, we're talking, well, $500 a year times 30 years, right? That's $15,000 extra you're going to get to pay just because, here's the kicker, because you have a higher credit rating. You have a 680 credit rating. And where is that extra money going to go? Well, guess what? It's going to go actually not to lower credit score folks. It's going to go for their benefit. It's actually going to go to the banks to help offset the risk for banks to do loans for people with lower credit scores. Now think about that a minute. You get to be punished because you happen to have a higher credit score than somebody else, and you get to pay an extra $10,000, $20,000, $30,000 over the lifetime of your loan because you have a higher credit score. Now think about this a minute. What does it take to get a higher credit score? It means you have to be financially responsible, right? You pay your bills on time, stuff like that. You do things what you should be doing. You're doing the right thing. What does it take to have a lower credit score? Not do those things. In other words, you just don't pay your bills on time. Your income isn't high enough or whatever. In other words, people that are doing the right thing, practicing financial responsibility, are going to get punished to benefit people who do not practice financial responsibility. And the people who get the money are not the people who are with the lower credit scores, it's the banks. Now, this is beyond ridiculous. This is crazy. This is punishing good behavior and rewarding bad behavior. Let's think about this a little further. What this does is it encourages, well, nobody wants to say the word, but it encourages subprime lending, doesn't it? It encourages offering loans to people who are riskier borrowers, who maybe couldn't quite afford it, or maybe shouldn't purchase that home because of their bad financial responsibility. Anybody remember 2008, 2009, the Great Recession, the financial crisis? What was the cause of all that? Bad lending practices, subprime lending, pushing loans onto people that couldn't afford it or probably shouldn't have had a loan because their credit score was low. Our government is pushing a policy that goes right back directly to what caused the last financial crisis. Folks, this is ridiculous. This is and by the way, let me give you another one. I haven't heard anybody talk about this one. For those who are purchasing a mortgage, purchasing a property with a mortgage, or doing a cash out refi or whatever, they happen to have the 680 credit score, so they get to pay the extra fee. Couldn't you call that a tax? The answer is, of course you could. It's being imposed by the government. That's called a tax. Now, who is authorized in our government to tax us? Let's go back to the Constitution. Anybody read the Constitution? Who can tax the American people? Who has the authority to enact taxation? The president? No. The executive branch? No. The judiciary? No. Congress. Congress is the only entity that has the legal authority to tax the American people. Now, who imposed this extra fee? Or you could call it a tax, right? Fee, tax, whatever. I think it's the Housing Authority, which is part of the executive branch, which is, it's under the executive branch, under part of the Biden administration. In other words, they have the bureaucratic federal agency makes changes without any election, without any debate, without any authority, frankly. It's the Federal Housing Finance Agency that did this. Now, what I would like to this needs to be fought in court, and I would be shocked if it isn't. Somebody needs to go to court and get this thrown out because it's unconstitutional. The Federal Housing Agency does not have the authority to impose a fee or tax on the American people. Only Congress does. So it's unconstitutional by definition. If that doesn't happen, I'd like to see people wouldn't this be great if people would say, well, I'm getting charged an extra $500 a year or whatever, $1,000 a year, depends on the size of your mortgage or cash out refi. And anybody heard of something called taxation without representation? I think we fought a king over that. Remember the Boston Tea Party? Stuff like that, right? There needs to be a pushback, and it is happening, to be fair. The mortgage industry and such are pushing back on this, but the fact that we even have to fight this is ridiculous. It's unconstitutional. But, this current administration doesn't care about that. And on that note, too, by the way, this is very ominous. Do you know that in the last 3 years, the IRS has spent over $10 million on weapons, ammo, and tactical gear? Now, think about that a minute. What does the IRS need with they already had apparently 4,000 firearms? Everything from pump-action shotguns to semi-automatic rifles to submachine guns. What do they need with all that stuff? And even the IRS applicants, when they're applying to work for them, it states on the IRS website, they must be willing to carry a firearm, must be prepared to protect themselves or others from physical attacks at any time and without warning, and use firearms in life-threatening situations, and must be willing to use force up to and including the use of deadly force. Is that ominous or what? Excuse me. I don't know about you. I don't like the idea of a weaponized IRS, but that's exactly what we're seeing. I'm going to finish up on a little bit of good news. I know all this stuff is frustrating. I get it. But at the same time, there are seeds, there are green shoots, like in in spring. You have winter, and then spring comes, and you start seeing some flowers pop through the snow or whatever. There's green shoots coming here and there are people stepping up and fighting back. And this is one of them that's interesting. I discussed this earlier in this show about ESG, and that's environmental, social, and governance initiatives. A lot of people are not really that familiar about what it is, but the reality, what it boils down to is, and the Biden administration has authorized, IRA and 401k administrators to follow environmental, social, and governance initiatives when making decisions instead of focusing on their fiduciary responsibility of maximizing returns. It goes completely, it's interesting. I'm in the financial industry, and over the past decade or so, there was a huge fight. It was started by Obama and this huge battle about fiduciary responsibilities and what our advisors and institutions had, what type of fiduciary responsibility they had in, with people's investments. And now they're going a whole different direction, say, well, you can use environmental, social, and governance initiatives to make financial decisions, investment decisions. Obviously, that means your returns aren't going to be as good, are they? And that's what's happening, is exactly what's happening. Those that are on top of this are letting their advisors know, hey, I don't want to have anything to do with this, but the choices are getting fewer and fewer because more and more of these, like BlackRock and Fidelity and all these big investment firms are following these ESG guidelines. Well, here's a step in the right direction. The state of Oklahoma has now banned more than a dozen woke banks from doing business because of ESG initiatives. Folks, this is a step in the right direction. The state has banned doing business with BlackRock, Wells Fargo, JP Morgan, Chase, Bank of America, State Street, among others. Folks, this is important. And if other states follow the lead of Oklahoma, that will get their attention. You get them in the pocketbook, folks. That's where you make the difference. Encourage your representatives to follow Oklahoma's lead. Stay tuned next week. Contact me if you want more information on how to navigate all this stuff. If you want information on how to make sure your bank is safe, your money's safe in the bank, what to do, how to maximize returns, minimize borrowing costs, especially with high interest rate environment, reduce market risk, all of those kinds of things, reduce taxes. Contact me at yourpersonalbank.com. And of course, stay tuned next week.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.